So, Aiden, the one thing people hate about Roth conversions, at least I hate it, and I think you probably hate it too, is taxes,
Yeah.
right? So, what if there was a way to eliminate effectively taxes on a Roth conversion and at the same time do something good and charitable?
Yeah.
That would be a pretty good idea, right? So, that's what we're going to talk about today. The topic today is how you can make Roth conversions virtually tax free by making charitable contributions. In fact, no more in many cases than the charitable contributions that you're already doing.
And make sure you stick around because we're going to go through a good detailed example of how this can actually work in a real situation. But my name's Aiden Borstein. I'm here with my father, Steve Borstein. We're both financial planners, and these are situations that we deal with in our everyday clients' lives. And we thought it was a great topic to go over because, like you said, a lot of people don't like Roth conversions for the fact of they have to eat the burden of the taxes now, even though it could save them in taxes later. Paying taxes now is paying more taxes now is a harder thing to do.
The fact is that about 90% of people don't itemize. So what they do each year on their taxes is they get what the IRS calls your standard deduction, right? But they don't have enough deductions in order to exceed that and itemize and really take advantage of some of the additional tax benefits you can get by doing so.
And the interesting thing is that even though most people don't itemize, about 73 to 81% of people donate to charities, which means that in a lot of cases, when people are donating to charity, it's not really affecting the bottom line of how much they owe in taxes. It's not reducing the amount of taxes they owe at the end of the year.
So essentially, they're doing something good, charitable giving, which they wanted to do anyway, but they're not getting an additional tax benefit that they're really entitled to if they just took advantage of this strategy that we're going to talk about today.
So here's basically where the strategy of lumping comes in. This is kind of part one to this strategy that we're talking about today. So what is lumping?
Lumping is when you take multiple years of donations and you're able to take the tax deduction in that first year, essentially. So let's say you normally give to charity $15,000 a year. Rather than from an IRS standpoint, give $15,000 in year one, in year two, in year three, in year four, in year five, you donate the entire $75,000, that $15,000 times 5 years in year one. So you're going to exceed the standard deduction and you're going to get a very large charitable deduction and offset a lot of the taxes that you would have paid, or all of the taxes that you would have paid on that Roth conversion, by being able to lump these charitable contributions all into 1 year. And it doesn't mean that you have to give that $75,000 to your charities in year one. You can still spread it out over those 5 years, but this is simply a tax strategy to be able to do that.
And that's a good point. So you said you could take the charitable deduction in 1 year and you don't have to give it all out in that single year. So we're going to talk a little bit after this example about how to actually do that. But now let's jump into the example and show you what a real scenario could look like when we're doing these charitable contributions and Roth conversions.
This is a scenario that's very, very similar to a client that we actually just did this for not too long ago. We've run across this scenario multiple times.
So let's jump into this example. Let's say you have a couple, and let's say that their interest and dividends are about $55,000 for the year. Maybe they take about $50,000 from their IRA distributions. They have some long-term capital gains as well of about $70,000. So their total income, their adjusted gross income for the year, is $175,000. Now, let's talk about the charitable contribution because we talked a little bit about itemized deductions and standard deduction. So they're contributing $15,000 to their charity of choice every year, but they're still only taking the standard deduction. So at the end of the year, their total taxes are $9,600 roughly. Now let's jump into the year where they're actually lumping, like we said, these charitable contributions. So we're going to say everything is the same interest, same distributions from IRAs, same capital gains. But instead of doing $15,000, they're going to do the next 5 years of contributions in 1 year. So they're going to have charitable contributions of $75,000 for the year. So now instead of them taking the standard deduction, now they get to take itemized deductions, and it's $85,000 compared to the standard of $34,000. Now this allows them to do a Roth conversion of about $47,000 and pay almost exactly the same in taxes as they paid the year before. So the first year where they didn't lump, they paid $9,600, and the year where they lumped and did the Roth conversion, they paid $9,700 in taxes.
So almost the same exact amount of taxes, but they were able to do a $48,000 Roth conversion.
Exactly. So this offsets, this almost essentially wipes out all the taxes that they would have owed if they did the Roth conversion without lumping those charitable contributions.
And over that 5-year period, they didn't make any more or any less charitable contributions than they normally would have made, right?
Exactly.
Just the difference is by lumping it together, they actually got to get a tax benefit from that charitable contribution.
So now a lot of people might be thinking, well, that sounds great. I'd love to do $75,000 in 1 year, but where is this money going to come from? Well, for some people, it can come from their cash flow. If they have a high income and they have a lot of excess cash flow that they don't need for their living expenses, they can just contribute the $75,000 in cash from their cash flow. Another way that this person could fund this $75,000 in this scenario, aside from cash donations, could be just taking money out of taxable investments, money market accounts, or brokerage accounts. But you can also donate things like stock. So there's a few different ways that you can actually fund this charitable donation.
So one of the important things to understand is what you donate and which charities you donate to could have an effect on how much of a deduction you can take in a particular year, which means that'll also have an effect on how much of a Roth conversion you can do. So it's important to understand those two factors and factor that in ahead of time before you do the Roth conversion. Otherwise, you might be up for a big tax surprise.
So now let's actually look at a scenario where somebody donated stock. Let's say they had donated a highly appreciated stock, so they're essentially donating the capital gains to that charity. So in that scenario, this person was able to deduct out of the $75,000 of capital gains that they contributed, they were able to deduct $62,000 because essentially the amount that you can deduct is less for donating capital gains than it would be if you're donating cash. So they can deduct $62,000, which means that their total itemized deductions for the year are $74,000, so a little bit less than the cash donation scenario. And this means that because their itemized deduction was a little bit less, that they can do a Roth conversion of about $38,000 if they want to pay the similar amount of taxes that they typically pay.
But can they carry that donation to the future year?
Yes. Because they weren't able to take the full deduction of capital gains, they can carry forward the additional, in this scenario, $11,000 to a future year.
The other really great thing about this strategy of donating stock, highly appreciated stock, is if you didn't do it this way, let's say you sold the stock and then donated the cash from proceeds from the stock. The problem with that is that you sold the stock, you now have to pay tax on any capital gains that you made on that stock. And now you're donating it, right? By actually donating the highly appreciated stock, you never have to sell it. It's just donated to the charity. So you reduce your taxability even further because now you've donated something and you didn't have to sell it.
Yep, exactly. Yeah, so this is a common scenario that we've actually helped clients with, right? And one of the things that someone may worry about when donating a large amount in 1 year is maybe they don't want to give the money out in one singular year. Maybe they want that money to stretch over the course of 5, 10, 15 years, but they still want to take the deduction this year.
So if you want to donate a large amount, like the $75,000 in this example, but give it out over 5 years or more or less, I mean, you could do it over 2 years or however long you want. The best way to do that we found, or one of the best ways, is called a donor advised fund. I mean, you could do a foundation, you can do a bunch of different types of charitable setups, charitable trusts, but donor advised funds are easy to set up. They're easy to administer. Most of them are relatively low cost, especially through some of the major custodians. And what it does is it allows you to contribute the $75,000 to the donor advised fund. You can't take the money out for yourself because you've donated it, but you can manage the investments in there. And if they grow, essentially you'll have even more money to give to the charities that you want over time. And then whenever you want, throughout the year or throughout years, you can donate to different charities through that donor advised fund. One of the nice things is at the end of the year, you get one statement that shows the charities that you gave to. But overall, it's a really great way to be able to do the lumping that we're talking about, but then give the money over years.
So be aware that every year taxes typically change, right? Tax laws can change, your personal tax situation can change. So in our practice, when we're working with clients, we take these types of things year by year. So you take a look at what last year looked like, you take a look at what this year is expected to look like, and you say, how much can I contribute to charity? How much can I do a Roth conversion for if I want to keep my taxes exactly the same? So it's really a year by year thing. Obviously, we highly recommend having a financial plan in place, having a tax plan in place, working with financial professionals to make sure that those things are accurate, because there can be scenarios, especially even scenarios with other financial professionals, that may not know the strategy that you're trying to implement, that can result in you paying more taxes or getting less of a benefit than originally was intended.
Right. And none of this is tax advice. This is all education, right? Because everybody's situation is different. If you have an accountant or you have a financial planner and they can implement this for you, that's great. But if not, please feel free to contact us because we'd love to talk with you.
So if you like this video, like and subscribe and leave a comment down below, and we'll see you in the next one.